All right, everyone, we are live. My name is Matt Inslee. I'm the publisher here at Paradigm Press. I'm joined by Jim Rickards and his senior analyst, Dan Amos. We're coming to you with an emergency briefing here. If you've been watching the news or if you haven't and you've just been watching the markets fluctuate, we're going to be covering a dramatic change of events, market fluctuations, and all starting with the failure of Silicon Valley Bank. The FDIC has stepped in. There's a lot of moving parts here, and we're in a pivotal time. So in the next few days and weeks, this whole story is going to come out. But before you hear it, we want to make sure that you're prepared. So today we're going to be talking winners, losers, and questions like, will there be a run on the banks? What's going on for investors? And then essentially what we want to do structure-wise, we want to cover what has happened in the last few days, what's happening now with the FDIC stepping in. And then more importantly, we're going to talk to Jim and Dan and talk about what's to come. So Jim, I will let you kick it off from here. A lot of things have happened in the last couple of days. We were just talking last week about some of these things that were happening with Silicon Valley Bank, but a lot of new information. If someone's not caught up on anything, can you start from the beginning? Let us know what happened, and then what happened, over the weekend with the FDIC stepping in, and what's happening now.
Sure. The thing is, Matt, when you say start from the beginning of what I mean by that is there's kind of a narrow timeline and a broader timeline. I'll do both very quickly. So the narrow timeline is that Silicon Valley Bank, the leading bank to the tech industry, some very large firms are customers there, hundreds of millions, if not billions of dollars of deposits, but also a lot of tech startups. Maybe you got $5 million of seed money and you put the whole $5 million into Silicon Valley Bank, but they're the darling bank of Silicon Valley. Well, when you get the deposits, you got to do something with them. You can make loans or you can invest in bonds. They did both. They were about $75 billion in loans and $75 billion in bonds, where they bought mostly treasury securities. But again, a lot of the loans were to the same companies that were making the deposits. And in fact, it would be the other way around, where the Silicon Valley Bank would lend to a startup, and they would lend by crediting their checking account or savings account at Silicon Valley Bank. So the assets and the liabilities were both very heavily oriented to tech firms of all kinds, communication startup, et cetera. But what kind of bonds did they buy? They bought very long maturity, high duration, very volatile bonds. U.S. Treasury bonds, a lot of them were 30-year bonds. Now, people say, are they risky? Well, there's almost no credit risk, but there's a ton of market risk. And when you talk about risk, there's credit risk, market risk, settlement risk, foreign exchange risk. It's a whole bundle of risk. Not much credit risk, but a ton of market risk. And just, bond math 101, the longer the maturity, the more volatile the bond is. And what that means is that when interest rates start to go up, so, bond math is rates go up, the value of the bonds go down, or rates go down, the value of the bonds go up. It's a little counterintuitive, but that's exactly how it works. So what's been happening to rates? Well, they've been going up a lot, 5% practically over the course of the past year. That means if you bought a 30-year bond more than a year ago, which the Silicon Valley Bank did, that bond has lost a lot of value. It's gone way down because interest rates have gone up. So they have these huge losses. So why didn't this happen a year ago? Why didn't we know about the losses? Why didn't we see this coming prior to, last Wednesday, let's say? Well, the answer is that a bank can put the bonds in something called hold to maturity, HTM for short. It's a loophole to market accounting. So if you put your bonds in the hold maturity account, you don't have to market to market. If you paid 100, you can carry it on your balance sheet at 100, 100% or whatever you paid. And even though it's going down in value, which it is, you don't have to record that. A hedge fund does, other investors do, but a bank does not. The problem was that, so they had large losses, but the losses were hidden because they were never marked to market. Something happened. I suspect there were leaks from inside the bank. By the way, there's a lot of corruption around this. The insiders, the CEO of the bank and some of the 2 or 3 top officers, started dumping their own stock in January, like a lot, millions of dollars worth of stock. Now, let the wheels of justice turn. I'm not accusing them of insider trading, but it sure looks suspicious when this bank is going down and the insiders are selling the stock in January and February. Anyway, word gets out, as it always does. It's usually word of mouth if you're, close to an insider, next door neighbors with somebody that you knew first, you knew before everyone else knew less. So people start pulling their deposits out. Now, this is where the hold to maturity accounting gimmick broke down. Yeah, you can hold a maturity, you don't have to mark to market. But if the money's walking out the door, and it was by the billions, at some point you have to sell the bonds to pay the depositors. The minute you sell, that loss is realized. It hits you all at once. It was not accrued or anything else. It hits you. Well, they had to report the loss because they're a bank, they're regulated, and they're a publicly traded stock. So they reported a major loss last week, something I believe it was upwards of $2 billion approximately. And this shocked the market. The CEO, what's this guy's name? Greg, I'll get his last name here, but the CEO goes on television and he says, don't worry, everything's fine. I'll never forget the CEO of Bear Stearns in March 2008, when Bear Stearns was going under, the CEO went on CNBC and said, don't worry, it's all fine. They were bankrupt 3 days later. When a CEO should be quiet if everything's good. If a CEO says it's all fine, get your money out fast because it's not all fine. This is kind of how they roll. So the guy's name is Greg Becker. He was the CEO. So he says it's all fine. Get your money out because it's not. So then they said, well, we're going to raise capital. This was kind of Wednesday afternoon going into Thursday morning. Goldman Sachs is our underwriter. That's another kiss of death. If Goldman's trying to help you out, they're probably trying to stab you in the back. And then General Atlantic, which is a major VC private equity investor, said we'll put up $500 million. They were trying to get I think $2.5 billion to make up the loss and give them a little bit of a cushion. General Atlantic said we'll do $500 million, but if somebody else does, like if you get another 500, we're in for 500. Never happened. It fell apart as quickly as possible. They pulled the offering, so they weren't going to get new money, and the deposit outflow continued. So they make it to Friday morning, and then at that point it's over. And by Friday afternoon, the FDIC shut the bank. Now here's what the FDIC did. That's Federal Deposit Insurance Corporation. Here's what they did Friday afternoon. And I want to explain this because they did something completely different on Sunday night, Sunday, the 12th. So Friday afternoon, they said, we're shutting the bank. All deposits up to $250,000 are fully insured. You'll get your money. They moved it over to a new bank. It was called the Deposit Corporation Bank of Santa Clara, some technical name. Actually, no account holders at Silicon Valley Bank. They were under the 250. But okay, you'll get your money Monday morning. But everyone else, you're wiped out. By the way, they didn't freeze those deposits. Those deposits were gone. And they said, what we're going to do is give you a certificate, a certificate in place of the deposit, and we'll tell you what it's worth. We'll get back to you on what it's worth. It's completely illiquid, can't use it for anything. They said what we're going to do is sell the assets, get the money, see how much money there is relative to these liabilities, and then we'll pay them off, as and when possible. But could be a year, it could be longer. Who knows how long it's going to take to sell the assets or what they're going to be worth. Nobody knows. Well, if you're a startup and you got, let's say, $5 million of venture capital from Kleiner Perkins or somebody, and you had it all in Silicon Valley Bank, your $5 million is now gone. You're holding a certificate that's of uncertain value, but you can't meet payroll. I mean, you might have a payroll Monday morning. You can't pay your vendors. You can't pay your rent. You can't pay the light bill. You can't do anything. You're basically out of business. And then, so there would have been a wave of bankruptcies, and then that would have rippled through to the venture capital firms, et cetera. So and by the way, it's just a little pro tip for our investors. These things always happen on a Friday. They always happen on Friday because they need the weekend to figure it out. So watch out for Fridays. So anyway, so that's the story as of the end of the day, Friday. So over the course of the weekend, the Treasury, Janet Yellen, Ms. Clueless, Jay Powell at the Fed, who actually does know a lot about these kinds of things, and Martin Gruenberg, the head of the FDIC. And I'm sure there was a lot of input from the White House, from Lael Brainerd, because remember, she just moved from the Fed to the White House. So no one in the White House knows much about this, but she does. So she's the White House kind of point person on this. So they came up with a new plan. It was announced 6:15 Sunday night. No coincidence, because 6 o'clock Sunday is when the futures start trading and they open down. So they said, okay, we've changed our minds. We're not going to limit the insurance to $250,000. Just blew it away. Unlimited insurance. All depositors are fully insured. If you had $5 billion in the bank, you're getting $5 billion, not 250,000, et cetera. So, and just a quick aside, Matt, that business of sticking to the deposit insurance and not paying for the rest, that's called a bail-in. We're used to bailouts. We've seen those a lot. But the bail-in is, no, we're not going to use taxpayer money to, bail out the rich guys. The depositors are actually going to lose. And this was something they came up with in 2014. It was 9 years ago. But the problem is, in 9 years, there hasn't been a bankruptcy of this magnitude. They've never had a bank resolution in the whole 9 years where they actually had to do what they said they were going to do, which was bail in, not bail out. They tore that up, threw it to one side, bailed out all the depositors 100%. So the FDIC did a 180 in 48 hours. But anyway, that's what came out Sunday night. But they went beyond that. So the Fed chimes in. They got to do their bit. So they came up with something called let me get the exact name here. It's the bank. Where is it? So yeah, the Bank Term Funding Program, BTFP, Bank Term Funding Program. What is this? This is for every bank in the country, every member bank, not just Silicon Valley or Signature. They said the door's open. Send us all your treasury bonds or any of your mortgage-backed securities, whatever you got. We'll give you 100 cents on the dollar, 100% collateral, or no margin, in other words. Now, bear in mind, all these other banks had the same problem Silicon Valley Bank had. It was they bought the bonds at lower rates. They're not worth as much. So it's like my car. I don't think I got a 13-year-old car with 220,000 miles on it. My dealer won't give me anything for it, so it's worth zero. But if I could hawk the car for what I paid for it, which is like 70,000, like here's a zero value car, but you're going to give me 70,000. I'll take that deal. But that's what they said to the banks. So now you're going to get this wave of bonds, notes, mortgages. Some of them really crappy. Some of them 10, 15 points below par. So you paid 10 million, it's only worth 8 million. The Fed's going to give you 10 million and hold it on a 1-year loan at a very low interest rate. It's like a kind of a short-term overnight swap rate, but it's very low. And by the way, 1-year loan, I guarantee you, Matt, when we get down a year from now, they're going to extend it a year. But
and is that's for any bank?
Any bank, any member of the Federal Reserve System, shoot your bonds and mortgages in. We'll give you 100 cents on the dollar, even if they're only worth 80. Now it gets worse because the Fed doesn't mark to market, so they're giving you 100 cents on the dollar. They're taking the bond and they're putting it on their balance sheet at 100. It's not worth 100. It's worth 80, 85. Maybe 90, depending on when you bought it. But they're going to mask the losses on both sides. So the Fed's going to mask the losses because they don't mark to market. The bank is going to mask the losses because they just got cash. Cash is always par. And then the banks are going to take the cash and give it back to the Fed in the form of excess reserves because they don't know what else to do with the money. So what's that going to do to the Fed's balance sheet? It's going to blow up the balance sheet. The assets are going to blow up because they're taking all the bonds in. The liabilities are going to blow up because they have more excess reserves. Now, what has the Fed been doing for the last 15 months? They've been shrinking the balance sheet. Now you just handed out an open multi-billion, maybe trillion-dollar invitation to every bank in the system to shoot in their bonds, and the Fed prints the cash. I mean, the cash just comes out of thin air. They're going to blow up the balance sheet after they spent a year trying to shrink it. This just, on top of the bailout and everything else that's going on, this just completely destroyed the Fed's credibility on the subject of monetary tightening and fighting inflation and all the above. And we're already seeing that, and Dan will talk more about this, in the price of gold, which is up $100 an ounce just in the last just over the course of the past week after Silicon Valley. So that's all bad enough, but again, it gets worse. So they not only bailed out the depositors, they bailed out every bank in the country that wants to send in bonds that are underwater. They bailed out the owners, because all these little startups we talked about, they all have owners. The owners are the big guys. They bailed them out. It was a whole weekend of billionaire crybabies. You got, Mark Cuban, Bill Ackman. These guys are all multi-billionaires. They're on TV. Oh, the system's going to end, whatever. Well, they're the guys who got bailed out, directly or indirectly. So, so that's kind of where we are. So as of now, as of as of March 13th. The Fed has bailed out every bank in the country that wants to send in bonds, and they will, believe me. They've bailed out every depositor, regardless of the federal deposit insurance limit. They've bailed out tons of billionaires because they're the ultimate owners. When you look through a couple layers, they're the people who actually own all this stuff. And who pays the cost? The American taxpayers. And Biden said, we won't use one nickel of taxpayer money. That's a complete lie, because you say, okay, where's the money coming from for this bailout we just talked about? $25 billion comes from something called the Exchange Stabilization Fund. People roll their eyes. What the heck is that? The Exchange Stabilization Fund was set up in 1934 based on insider trading profits by FDR. Franklin Delano Roosevelt stole all the gold from the American people, He gave you $20 an ounce in paper money that you couldn't convert into gold. He made gold illegal. He then took the $20 gold, marked it up to $35 on the government's books. So it was a 75% markup, the ultimate insider trade. Well, that profit is the Exchange Stabilization Fund. It was created in 1934 by stealing gold from the American people. They're using that same fund 80 years later, almost 90 years later, to bail out billionaires again. So first they steal the gold from everybody, then they bail out the billionaires. And then the other source of funds is they're going to increase the premiums for FDIC insurance, because the money will come out of the FDIC insurance fund. Well, this is going to deplete the fund, so you got to top it up. They're going to increase the premiums. Okay. And they say, well, the banks are going to pay it. Well, what are the banks going to do? They're going to pass it along to you, either in the form of lower interest rates or higher fees, probably both. So everyday Americans are going to end up paying for it just because you're washing it through the FDIC system. You're going to end up paying for it. So whether it's stealing Americans' gold or reducing the interest on their deposits, the American people always have to pay.
Wow. Jim, I want to get your take on it in a second of where we go from here, because we're in a very pivotal time here in between all of this stuff happening. And then we've got the FOMC, the Fed meeting is coming next week as well. So this is going to be a very, very important time. But first, I want to get to Dan. Dan, as Jim's senior analyst, what else are we missing here? Because I know you're tuned in very well to small banks, interest rate payments. You've come up with ideas that, like, some of these companies are kind of in a death zone where interest rates are so high they can't live. Add some color here.
Yeah, absolutely. A lot of people got flashbacks to 2008, and Jim and I were around in 2008 watching stuff unfold in real time, and having Sunday night meeting after Sunday night meeting, and having loan facilities. It reminded me of March 2008, the rescue of Bear Stearns and the funding facility that the Fed rolled out to help finance, having JP Morgan take over Bear Stearns. And this was like 6 months before the fall big crisis. And at the time, I remember thinking, everyone thought this is just a liquidity issue. As soon as we fix this liquidity problem, as soon as we roll out this lending facility, everyone will calm down and the banks will be able to earn their way out of this problem. It turns out it was a solvency problem, right? It was too much bad debt written at too low of a rate to compensate for the risk. In this case, this bank run was, I would say, unprecedented in history, not only for the speed of it and the size of it, because it basically happened on smartphones, and this is why things changed so dramatically between last Friday and Sunday night. As Jim was saying, they were panicking. They must have had calls all weekend saying, people got out their smartphones and pulled out of our bank, Treasury Department, you need to do something about this. We won't be able to open on Monday. But I believe the number was 40 or $50 billion in 48 hours just left Silicon Valley Bank. And as Jim was saying, the assets that back up all those deposits, it's not like 2008 in the sense that these are private label mortgage securities that were sliced and diced and you have no idea what the market value is. These are MBS, mortgage-backed securities, that are guaranteed by Fannie and Freddie for the most part. They were the most illiquid. They're the most complex because they have prepayment rates. They have something called duration extension, that when mortgage rates rise, the duration of those securities rises. And I put out a commentary relating this to It's a Wonderful Life, the old Bailey Building and Loan story that I think you all will receive today. But in a nutshell, the issue with their balance sheet was there is a market price for all those securities. It's just that Silicon Valley Bank could not sell at that price and satisfy the unbelievably large $50 billion hole in their balance sheet to pay out all their depositors. So they just said, we have to just pause everything. We have to get the FDIC to take us over. And that's how we'll deal with this. So this facility that they rolled out Sunday night, had this been in place prior, like a week prior, Silicon Valley Bank would still be here, because in a sense, they said what caused this crisis was liquidity. And we need to be able to have any other bank, whether it's like, Charles Schwab is in the news now, Western Alliance Bank. There's a few other regional banks kind of in the same position where they're sitting on big underwater losses on their mortgage securities, that they say we're having it in this hold to maturity bucket. It'll be fine. It's government guaranteed, Fannie guaranteed securities. As long as we can hold them until maturity, we'll be fine. We're solvent. But as long as this deposit flight issue is an issue, it's now things are now to the point where they need to have access to cash immediately, and this is what the Fed's providing. You know, and what's unique about this facility is there's no haircut, meaning they can take their Silicon Valley in the case of, I believe they had it $90 billion roughly was the historical cost, and the market value was something like in the 60s. So there's like a $20 to $30 billion hole there. They would have been able to get all 90 billion in cash from the Fed up front, and then swap those bonds back for cash over time and just basically earn their way out of the hole. Because many banking crises are just about giving the banks time to earn their way out of their problems. And so that's what they panicked, they reacted, they did that. But as I mentioned in the commentary, It's a Wonderful Life commentary that's came out, the main issue that I see with the stock market is, I do think regional bank stocks will continue to perform poorly because they had been paying depositors anywhere from 50 basis points to 1% on overnight, checking account money. And that is so far below the benchmark Fed rates and Treasury bills that the market is now looking ahead and saying, hey, to keep deposits from fleeing, you guys now have to pay much higher rates on your checking accounts. And that's going to lower the net interest margin. It's a technical term, but it's the difference between what the banks earn on their assets and they pay on their liabilities. If that squeezes, then the banks will have less money to offset bad loans. And so if that's the case, the market's looking one step beyond that and saying that's going to force the Fed to cut, looking out 6 months, 9 months. And to tie it together, like to what you asked earlier, the death zone, it's like we put out a commentary in Countdown to Crisis last year about the death zone. This is about mountain climbing, and above a certain level, if you're a mountain climber, the oxygen concentration gets low enough and you don't really realize it, that you can have asphyxiation. And so it's a risk. And the parallel to companies in the financial sector and just in the corporate bond sector is so many companies, after 10 years of almost zero rates, got used to easy loans, easy lending. And if we're in this high rate environment combined with this new flighty deposit phenomenon, a lot of companies, a lot of stocks that, were just set up for this environment are not ready to handle tougher financial conditions.
Matt, one thing I'd like to add quickly to what Dan just described, don't underestimate the amount of corruption in all this. I talked about the CEO and the insiders selling stock before the crash, which they did. They have to report that, and that is publicly known. But the CEO of Silicon Valley Bank, his name is Greg Becker, was on the board of directors of the Federal Reserve Bank of San Francisco. He's a director. He's a Fed insider. The other bank that failed is called Signature Bank. One of the directors of Signature Bank is Barney Frank. Barney Frank, his name sounds familiar. He was the chairman of the House Banking Committee when they wrote Dodd-Frank. Dodd-Frank is Barney Frank. So he was the ultimate Washington insider, and he's on the board of Signature. So you got a Fed insider and a congressional insider who wrote the Dodd-Frank law, and they're the two guys getting bailed out in these two banks, Silicon Valley and Signature. So, not to mention we talked about all the billionaires who are behind all the investments that would have failed if it hadn't been for the bailout. So once again, the Washington insiders are bailing out other Washington insiders, Fed insiders. By the way, the Fed just got through an insider trading scandal over the course of the past 2 years. They had other regional reserve bank presidents in, I believe, New York, Boston, and elsewhere who were trading insider trading during the COVID pandemic. They had enough government information to know that this thing was worse than a lot of people knew at the time. So the Fed just got one insider trading scandal behind them. And now you have a director of the Federal Reserve Bank of San Francisco potentially doing the same thing. Let's see how it turns out. So it's just, it's the government protecting the powerful, protecting the rich at the expense of everyday Americans, business as usual as far as Washington is concerned.
Wow. Like you guys said, we're already seeing gold jump up. We wanted to get everyone that's watching the call right here to this information because, again, that's in a nutshell what's happening. A lot of big things happening from the past, the FDIC stepping in this week, and then what's going to come next week. Jim, what do you see without having to get, I don't need a finite prediction of exactly what's coming, but what are some questions that anyone watching this video, if they're an everyday American, they're a paradigm reader, what do they need to be worried about that could happen in the next week or so? Because we don't know necessarily what Jay Powell's going to do with rates next week. But they've been, like you said, year over year, rates went from 0 to 5. And now we're starting to see companies die in the death zone because of those high rates. Like, what's coming next, and what do we need to pay attention to?
Well, I'll give you 3 fiascos in the making, all of which are coming to our readers, keep our readers ahead of the curve. And every one of these is bigger than what just happened. So that's how bad it is. So let's start with Jay Powell monetary policy. So March 22nd is the Fed meeting, and there was debate about whether they would raise rates 25 basis points, which is pretty much baked in the pie, or whether they might have to raise it 50 basis points because the the January jobs report, the February jobs report both came in hot. Inflation came in hot. There'll be more inflation readings in the meantime, but there was a lot of reason to think that it might be 50 basis points. But now you have to say, well, wait a second, it could be 0. I mean, if this whole thing happened because the Fed was raising interest rates and they just bailed out the entire banking system, and a lot else besides, are you going to keep raising interest rates? I mean, how big a hole do you want to dig? How many bonds do you want on your balance sheet? So that's the first thing. My estimate is that the Fed will raise 25 basis points. 50 might be a call for given inflation, but that's probably too much too soon. So they'll stick to the 25 just to show they're still tough guys against inflation. But that's just going to make this whole situation worse. Number one. Number two, we talked about tens or hundreds of billions of dollars of bonds coming into, or maybe $1 trillion of bonds coming into the Fed balance sheet. Well, they got to print the money to pay for all those bonds. And by the way, Chris, as Dan said, they're overpaying for them because they're not paying the value, they're paying par. Well, what's it going to do for inflation? I mean, if the inflation was because of easy monetary policy to begin with, the Fed was trying to tighten to get inflation under control, but now they're going to print some number. We don't know the number, but easily in the hundreds of billions of dollars or more, upwards of $1 trillion. So that could light a match under inflation again. After fighting inflation for a year, we could see it come roaring back. Now it's too soon to know that, but that's one possibility. And the biggest one of all, and this could be $1 trillion meltdown, is because we haven't talked about crypto world. This thing, I said there was a short timeline and a long timeline, and I gave you the short timeline. Here's the long timeline. Go back to November 2021. Bitcoin was $69,000. Over the following year, it crashed 70%. It went down to about 16,000. Yeah, it's bounced back to 2021, but it was down 70%. Well, Bitcoin's, it's a digital code, it just kind of floats around. It is what it is. But there were so many people who were leveraged to Bitcoin, custodians of Bitcoin, borrowing Bitcoin, trading Bitcoin, et cetera. You had a succession of major failures in the crypto world. 3 Hours hedge fund blew up. FTX, don't even, by the way, maybe Sam Bankman-Fried should have held out longer. He might have got a Fed bailout, instead of being under house arrest.
Yeah.
But FTX blows up, probably the biggest financial fraud in history. Genesis, which was another custodian. And then finally, and I was looking at that. We've been talking about that for a long time, keeping our readers informed or not. The question I kept asking is, okay, there's a meltdown in crypto world, and there was. Is there a chance, and it'll get worse, which it will, but is there a chance that flips, just like a virus? The math is exactly like the pandemic. Epidemiology and financial contagion, that's why they call it contagion. The math is the same. Is there a risk that virus, the financial virus, goes over from crypto world to the mainstream banking world and then sets off a bigger crisis? And I expected that, but I was like, well, hard to know where that's coming from. Well, it happened last week, about a week before Silicon Valley Bank. There was another bank that failed, called Silvergate Bank. Now, Silvergate was a regular bank in the sense that it was a member of the Federal Reserve System, had FDIC insurance and all, regulation, all that good stuff, but it specialized in crypto. It was a market maker to crypto buyers and sellers. It had crypto facilities, et cetera. So it was really a crypto bank, but it happened to be a real bank. And that was the bridge. The virus went from crypto world over to regular banking world through the bridge of Silvergate. So now it's in the mainstream world. And what happens within a week? Silicon Valley and everything else blew up. But now there's a feedback loop because Signature Bank, which is also a regular bank that failed, our friend Barney Frank was on the board of directors. That was also a crypto bank. They were offering facilities to something called a stable coin called USDC. Now, what's a stable coin? It says, well, give me $1 and I'll give you a coin that's worth $1. And if you want your $1 back, give me the coin, I'll give you the $1. So it's kind of like a money market fund. It was pegged at $1, except you have to ask yourself, well, I'm giving you all these dollars, getting all these stable coins. What are you doing with the dollars? Well, no one knows. There's no transparency. There's no audit. No one really knows. There's one called Tether where they had over half the assets were in commercial paper. All right. Commercial paper is an unsecured corporate IOU. Who's the issuer? I doubt it was IBM. It's probably, I don't know for sure, that nobody knows, but is it an affiliate of the owners? Have they siphoned up billions of dollars? Nobody knows. And that's the point. Well, USDC, which is this crypto, was relying on Signature Bank for something called Signet, which is a trading facility, and had huge deposits. Now, maybe those deposits are getting bailed out. But that coin, which is supposed to be worth $1, melted down to about 81 cents. It's back up in the 90s at this point. But you've got a risk that the whole stablecoin infrastructure is a giant fraud. I suspect it is. And if that melts down, now you're talking about, somewhere between 500 billion and $1 trillion, and that's just waiting to happen. So and then, oh, by the way, by bailing out Signature Bank, the Fed in effect was bailing out the crypto world. So they're not just guaranteeing hedge funds and banks and deposits and private equity and venture capital and everything else. They're now de facto guaranteeing crypto. So this thing is much, much bigger than we've seen so far. It's going to get a lot worse. And it will be beyond the capacity of the Fed to deal with because you can't even, the FDIC doesn't regulate crypto. Nobody does. But if you have to bail it out, then where are you?
Yeah. All right. Well, guys, Jim, I appreciate your time. Dan, I appreciate your time for coming on short notice. So I'll recap those things real quick that you just said, Jim. 3 things that we've got to keep our eyes on as regular Americans, paradigm readers. Watch out for that coming rate hike. That's kind of what got us into this problem. We've got another one coming next week on the 22nd.
Right.
Watch out for higher inflation, because with what's happening with the Fed's balance sheet, it might be going up sooner than you think and higher. And then the big one is watch out for crypto contagion. If it comes into the mainstream, again, that's just one of those pieces of, Dan, using your terminology, of the death zone. Crypto, some of these companies might be in that death zone. We don't know exactly what's happening, but as you can see, it can have a very real world effect on banks and liquidity, and that can come to bite everyone very quickly. So thank you, guys. We will be in touch. We want everyone to stay tuned that's on watching this call. We appreciate you tuning into this emergency briefing. But this isn't going away. In the next few days in between now and the 22nd, a lot of action to keep in mind. So stay tuned to your emails, and we'll be back shortly. Thanks, Jim. Thanks, Dan.
Thank you.